Welcome back, everyone. So as a follow-up to our previous explainer, why 2026 could break the US banking system, today we're diving right into the actionable steps you need to take. We've already talked about the massive financial storm on the horizon, but for most Americans, the question isn't just why it's happening, it's how do I actually protect my money before it hits?
We established in our last deep dive that a commercial real estate debt bomb, reaching upward of $1 to $1.5 trillion, is scheduled to detonate in 2026. That is just a staggering amount of money. It's the financial equivalent of a semi-truck heading straight for a brick wall.
And here is the absolute crucial point. If you have a 401k, a savings account, or a mortgage, you are connected to this banking system. You can't just sit this one out on the sidelines. You need to know how to proactively defend your wealth well before those systemic cracks start showing up in your personal finances.
So, today I'm handing you a straightforward, three-step survival playbook to recession-proof your finances before that 2026 refinancing wall arrives. We're going to quickly review the $1.5 trillion debt bomb, and then jump straight into setting up your cash firewall, defending your portfolio, hedging the bleed, and finally, how to actually thrive during the panic. Let's get right into it.
Starting off with our catalyst for this crisis, the $1.5 trillion debt bomb and the breaking point for regional banks. We're looking at a massive wave of short-term commercial real estate loans. Think huge office buildings and aggressively financed apartment complexes waking up to a highly toxic interest rate environment where the refinancing math just doesn't work. The real danger? Regional banks hold up to 80% of this debt. They've been playing a dangerous game of extend and pretend, basically rolling over bad loans to avoid taking massive hits on their balance sheets. Because of this, the latent distress, the actual rot underneath the surface, is roughly 4 times worse than the 1% delinquency rates they're officially reporting. This is a massive solvency crisis just waiting to boil over.
Which brings us to step 1, building your cash firewall to secure immediate liquidity.
The 2023 bank failures taught us that even supposedly safe institutions can face rapid, devastating liquidity crunches. When panic starts, you do not want your cash trapped. For my US viewers, you absolutely must check your FDIC limits. We all know that $250,000 number, right? But what a lot of people don't realize is that insurance only covers $250,000 per depositor, per insured bank. Meaning if you have $300,000 sitting in a single savings account, $50,000 of your hard-earned money is completely exposed if that bank goes down.
But there's an incredibly effective solution here. If you're fortunate enough to be over that $250K limit, you don't need to manually go open accounts at 10 different banks. Just look into CDARs or sweep accounts. Brokerages and bank networks use these programs to automatically spread your excess cash around multiple partner banks behind the scenes. It keeps every single penny fully FDIC insured, all under one simple login.
So here's your action plan. First, audit your current bank exposure. Second, please do not leave your money in some big-name legacy bank earning 0.01%. Move your emergency fund into a high-yield savings account, an HYSA. You're going to get paid 4 to 5% interest right now, but far more importantly, you're building a cash firewall that insulates your liquidity from any localized banking shocks. All right, step 2, defending your portfolio against those commercial real estate shockwaves.
Most of our 401ks and Roth IRAs are heavily weighted in the S&P 500. While that's been awesome for growth, the 2026 crisis is fundamentally rooted in commercial real estate. If that debt bomb hits, sectors tied to this, like regional bank ETFs, specifically KRE, and certain real estate investment trusts, are going to feel intense heat. The pivot you want to consider here is moving a portion of your portfolio from standard growth funds over into value funds. Look at dividend aristocrats. These are companies with 25+ years of consistently increasing their dividends.
And historical data from Morgan Stanley confirms this perfectly. Quality cash flows matter immensely in a slowdown. These value companies have survived literally every banking crisis since 1999 for one very simple reason. They have the real-world cash flow to just completely ignore the systemic math problem we talked about earlier. They generate actual revenue. They aren't just relying on cheap debt to stay afloat.
Moving to step 3, hedging the bleed and protecting your purchasing power.
Listen, this probably won't be a 2008-style overnight crash. It's much more likely to be a slow bleed of refinancing pain. And what happens then? It forces the Fed to step in, cut rates, and provide liquidity, which almost always sparks inflation. So your move here is protecting your purchasing power. For Americans, look into TIPS, or Treasury Inflation-Protected Securities. These are government bonds uniquely designed so that your principal automatically adjusts upward with inflation. They basically absorb the shockwaves of central bank rescue efforts, making sure your money actually buys the same amount of groceries tomorrow as it does today.
You should also seriously consider carving out a small 1 to 5% allocation into non-correlated chaos insurance. I'm talking about alternative assets like gold or Bitcoin. Think about this. In 2025, as the dollar slumped to 9%, gold actually rallied a staggering 65%. Why? Because when the banking system gets squeezed, these safe havens are exactly where the big institutional money flows. You want your portfolio sitting there before that rush truly starts.
Finally, let's talk about thriving during the panic and how you actually become a prepared investor.
The 2026 maturity wall is a massive macroeconomic math problem, but your personal finances do not have to be a variable in that equation. By actively securing your cash with sweep accounts and HYSAs, pivoting your portfolio toward value and dividends, and hedging against that slow inflationary bleed, you are building an absolute fortress around your wealth.
A market decline is a huge threat to the unprepared, but it is a massive buying opportunity for those who are ready. You've built your financial fortress, and now it's time to take control of your financial future and thrive through the turbulence. You aren't just surviving anymore. You're prepared to be the one buying when everyone else is panicking. For a deeper look at the specific ETFs and assets I'm watching to execute this shift, make sure you check out our recent explainer on that exact topic. So I'll leave you with this. When the 2026 alarms finally ring for the rest of the world, what will be your very first move?